Greetings to judges and organizers. I'm Ho Shanwa, the team leader of Group Newbie. So here are my team members, who is Lim Yi Yang, Eric Yang Lai Xian, and Emily Tang Pei Jie. So currently, Orion Malaysia applies a 5% cost plus markup on all Malaysian manufacturing, and the Inland Revenue Board Malaysia argue that whether the existing 5% markup still reflects the arm's length principle, and Orion disagree with this adjustment, and they state that Orion Malaysia remains a low-risk contract manufacturer as they do not hold the intellectual property of product design and should continue to earn a routine return. So this is about our case background, and this is our main focuses to be discussed. So the first one will be the main transfer pricing issue relating to the 5% cost plus markup applied to Orion Malaysia. Next will be whether the 5% markup is at arm's length and how this can be assessed. And next will be what could happen if the current pricing is not changed, especially following the Malaysian tax audit. And lastly will be what Orion should do to address the issue while complying with the Malaysian transfer pricing rules. So before we start, we need to understand about how to differentiate a contract manufacturer and a full-fledged manufacturer. So as in the table shown here, a contract manufacturer should not set innovation as their primary goal and strategy, and their R&D and customers should be from their parent company in Germany, as well as having a routine return of profit model so that there will be low risk. Otherwise, by Malaysia tax guidelines, there should be full-fledged manufacturers and pay higher tax compared to contract manufacturer. Now, IRBM is arguing that Orion's functionality is too complex, that Orion might have R&D function and brand. Meanwhile, Orion said that they don't have intellectual property and maintain a routine return with a 5% markup from their cost plus method in their transfer pricing arrangement. So to further discuss, we need to understand about what is cost plus method and why there is a difference in their primary methods between Orion's and IRBM. So the difference exists because the calculation is based on a different key driver, which is gross profit for cost plus and net profit for transactional net margin method, TNMM. So from Orion's perspective, they look for the manufacturing cost and add the 5% markup. This is a bottom down approach, which is clean, simple, and focusing on the direct manufacturing function to Orion. And this cost plus method relies on internal data, but Orion won't know exactly what their competitors' product costs to make because their internal cost sheets are secret. So now let's look at IRBM's perspective. So IRBM look at the entire Malaysian entity. They don't just care about the cost, but they care about the functionality, net operating profit margin, and etc. This is a top-down approach using TNMM because it captures the total operational reality. And TNMM relies on public data by checking audited financial statements of every gear maker in Malaysia. Those statements always show net operating profit, but they rarely break down cost of goods sold in enough detail for a cost plus comparison. So in summary, cost plus is better for operations, which is a superior tool for price setting for Orion. TNMM is better for defense, a superior tool for audit compliance for IRBM to collect tax effectively. So from here we can see, according to IRBM's 2024 audit framework, it is designed to hunt for full-fledged manufacturers who disguise themselves as contract manufacturers. This is because Orion Malaysia, they look for higher profits, thus lower tax charged by IRBM is their main goal. Meanwhile, to IRBM, their main goal is to gain as much tax collection as possible. Therefore, they will conduct tax audits to prevent companies from pretending themselves as a contract manufacturer. If Orion Malaysia team is doing more than what normal contract manufacturer will do, such as improving gears design, hiring R&D engineers, and etc., the IRBM will argue that the 5% is an artificial trick to avoid high tax charges for full-fledged manufacturer. Therefore, there is a misalignment of value creation that Orion is being a high value chain but presenting themselves as a low value chain manufacturer. So as shown in this slide, we can see this is the overview of the core conflicts. So it can be separated into characterization, file profile, primary method, and justification. So from here we can see, basically in summary, Orion they claim that they are a contract manufacturer and their file profile is low functions, low assets, and low risk. Therefore, they think they are contract manufacturer, and but then this is another issue because they are using a primary method to determine whether they themselves is a contract manufacturer or not, and their justification is about routine labor deserves and routine 5%. And for IRBM, they will claim that Orion should be higher percentage such as 12% because of the functionality of Orion Malaysia. So next, I will pass my turn to next presenter.
Now I will talk about the question is 5% arm's length. The question on everyone's mind is our 5% legal? Under the arm's length principle, a price is only valid if independent companies in Malaysia would charge the same 5% for the same work. To assess this, we use a benchmarking study filtered by a FAR analysis which consists of functions, assets, and risks. And now we discover 3 steps to assess this. We move to the first step first. Step A, the localized benchmarking. The focus here is to look for comparables. If Orion is a contract manufacturer, we filter for companies with zero R&D and zero inventory risk. If the IRBM is right and Orion is an full-fledged manufacturer, we filter for companies that own their own brands and patents. We move to the next step. Step B, the statistical percentage rule. Once we have our list of 10 to 15 peer companies, we don't look at the average, but the 37.5 to 62.5 percentile. If the market range for contract manufacturer is 5% to 8%, then Orion's 5% is arm's length. If the market range for full-fledged manufacturers is 9% to 14%, then Orion's 5% is not arm's length. And next, step C, the method verification, which is a transactional net margin method versus cost plus method. The IRBM will likely use transactional net margin method because it is harder to hide or misstate the profit in the net margin. They will calculate the net markup on total cost. If Orion's 5% gross markup results in a 1% net profit, but the industry net profit is 4%, the IRBM will adjust Orion's tax bill hours. If the market range for routine manufacturers is 6% to 9%, 5% is not at arm's length. It doesn't matter if 5% is following global policy, if it should fall between the 37.5 to 62.5 percentile of Malaysian statistical benchmarking. Therefore, it is legally wrong in the eyes of the IRBM. In the final conclusion, the 5% markup is only arm's length if it falls within the appropriate benchmarking range based on accurate file analysis. Otherwise, it will be adjusted by IRBM. Now, I will pass to the next presenter.
Now we move on to the question 3. We analyze the consequence if Orion Malaysia continues using the 5% cost plus markup after the RBM audit. The key concept is that the 5% markup is below the market range of 6% to 10%, which indicates it doesn't satisfy the arm length principle and may understate Malaysia's profit. As a result, RBM is likely to make a transfer pricing adjustment, potentially increasing the markup to around 7.5% to 8%, which is closer to the median. More importantly, this adjustment can be applied retrospectively for up to 5 to 7 years, significantly increasing the cumulative tax liability. In addition, a surcharge of up to 5% may be imposed under Section 148, regardless of whether the error was intentional. There is also a risk of double taxation, as Malaysia takes the additional income, while the German parent may not receive a matching tax credit. So overall, this creates multiple layers of risk, including higher taxable income penalties and cross-border tax inefficiencies. To illustrate the financial impact, assume a cost base of 100 million ringgit. An increase in markup from 5% to 8% generates an additional 3 million ringgit in taxable income. At the 24% corporate tax rate, this lead to 720,000 ringgit in additional tax, plus approximately 180,000 ringgit in penalties. This brings the total impact to about 900,000 ringgit per year. If applied over 3 to 5 years due to retrospective adjustments, the total exposure could reach 2.7 million ringgit to 4.5 million ringgit. From RBM's perspective, this adjustment is justified, as comparable firms earn higher margins, and Orion may be seen as performing more than routine functions. However, the company argues it performs only routine manufacturing activities without owning IP or making key strategy decisions. This argument is weakened by the absence of an updated benchmarking study since 2016, which reduced the credibility of its pricing. So in conclusion, maintaining the current markup exposes Orion to tax adjustment, penalties, and double taxation risk. Ultimately, this is a strategic risk, not just a compliant issue, and is essential to revise the transfer pricing policy and update benchmarking to mitigate future exposure. Now I pass to my next member.
Therefore, here are a series of strategic solutions for Orion Malaysia. First, Orion needs to resolve the arguments of complex functionality. The company should conduct an internal file analysis to ensure that it fulfills the criteria of a contract manufacturer. This means Orion Malaysia should only perform routine manufacturing activities and not take on higher labor functions such as decision making and R&D. Next is localized benchmarking. Orion can perform a local benchmarking study using the transactional net margin method, which we call it as TNMM, to ensure that its cost plus transfer pricing method is logically set. This benchmarking helps to provide market calibrations and standardizations. It also serves as a proof to the IRBM that the profit margins reflect the current market levels and complies with the arm's length principle. The third step is contemporaneous documentation, which addresses current issues. Orion should prepare its transfer pricing documentations in advance. Under the Malaysian Transfer Pricing Guidelines 2024, the company only has 14 days to submit its documentations once requested by RRBM. Therefore, early preparation is crucial. This also acts as a risk mitigation plan in case IRBM imposes penalties for non-compliance with the arm's length principle. Finally, the last step is the 2026 price reset, which is a long-term strategy. If the local benchmarking study shows that the market markup is around 7%, Orion should proactively adjust its markup from 5% to 7%. This helps eliminate any red flags and signals to IRBM that Orion is a transparent and compliant taxpayer. It can also act as a peace treaty, where both Orion and IRBM agree on a fixed markup for a few years, reducing future disputes. So in conclusion, these strategic steps will help Orion Malaysia strengthen its transfer pricing positions, reduce tax risks, and ensure compliance with regulatory requirements. Thanks. So that's all from us. Thank you for listening.